All right, so let's get started here. So my name is Gil Gutierrez. I'm actually a local real estate agent here in Orange County, for those of you who don't know. And, with everything going on right now, I've asked a good friend of mine, Ryan Gallo, who's a financial advisor. He lives here in Orange County, and so I've asked him to go ahead and speak with us today a little bit about what's going on in the market. Today, we're going to be covering a few things. Ryan will go ahead and give a little bit of background on himself. But we're going to be going over, one, the current state of the market, what's going on with the market right now. Two is if you were someone who is looking to retire in the near future, in the next 5 years, how should you be reacting? What should you be doing? And then if you're someone that has been, you're maybe 10 plus years away from retirement, again, how should you be reacting during this? What should you be doing? And Ryan will kind of go into that. So Ryan, if you're ready, let's go ahead and get started. And can you give us a little bit of background about yourself? I know you're a financial advisor, but for those who don't know, just kind of get some details on that, what you do, where you do business, and yeah, we'll get started. Go from there.
Yeah, thanks, Gil. Like you said, my name's Ryan Gallo. I'm a financial planner in LA and Orange counties. So I work out of a credit union actually called Credit Union of Southern California, and our wealth management department is called SoCal Wealth Management. So we work with members and non-members, anything financial planning related, helping people accomplish their financial goals. We put together financial plans for them. So I specifically am a chartered retirement planning counselor. My area of expertise is in growing money up until retirement, or once someone hits retirement, making sure that that money lasts as long as they do, managing that longevity risk. So that's what my day-to-day is spent mostly doing, is working with individual clients and helping them accomplish their financial goals.
Now, is that a specific, you mentioned a charter, is that a specific designation, or is that something that's a little bit maybe different than maybe another financial advisor may have, or what is that exactly?
Yeah, so it's a designation that I studied for through the College for Financial Planning. They offer quite a few different designations. The one that I specialize in is in the retirement planning space. So it's Chartered Retirement Planning Counselor, or CRPC for short.
Okay. Oh, okay. So real specialization in long-term retirement planning.
Exactly.
Okay. Perfect. Well, it's great. And you're alumni of UCLA, right?
Correct. Go Bruins.
All right. So for all you UCLA fans out there, all right. So can you give us I know a lot of people just recently, they're probably feeling a little bit better about things with where things are going in the current market. They're kind of seeing things that, maybe is it a recovery or not a recovery, but it's definitely not where it was a couple of weeks ago. But can you give us some, current background or just the current state of it, what you're hearing and, what you're seeing and your thoughts?
Yeah, this has been kind of a very interesting year, to say the least. So we came off of late 2019 in the market. We had a really strong year. And 2020 actually started off pretty well up mid-February. Once we hit mid-February, the market started having some turbulence, enter in COVID-19, and a lot of volatility ensued. So there was a lot of fear and panic that the market was trading on. And, the market is an anticipatory animal. It likes to try and anticipate what it thinks it knows and price things in ahead of time. And when you had so much uncertainty around this coronavirus, how many people have it? How long is it going to last? How devastating is it going to be here in the United States? What is business going to look like? There are more questions than there are answers. And, still to this point, we still have a lot of questions. There's been a lot of emotion and fear. And so much like what happens often in the markets, that fear and panic can lead to, some momentum trading. And so what we saw was from February 12th of 2020 up through about March 23rd of 2020, we saw this just emotional roller coaster of significant pullback. We had a 37% drop in the S&P 500 over that time frame. Since then, that momentum has kind of subsided a bit. A few big things have happened in the meantime. First and foremost, the government, the Fed, actually got together and decreased interest rates during that time frame pretty significantly. Yep. That didn't really do much to stop the panic and fear sell-off, but I'll speak about it later. I think it may help us get out of this. It may help kind of prop up the economy on our way out. The other big thing that happened was the CARE Act was passed. on March 29th, 2020. The market actually bottomed out on the 23rd based on the assumption that this CARE Act was going to get passed. And what it did is infuse the economy with stimulus checks to individuals, forgivable loans in a lot of cases to businesses to help kind of prop up those businesses. It's interesting because we entered into this pullback in a really strong economy. And so the thought process here is that if we can do some things, if the government can do some things to keep those jobs in place when the market, when we do, release the workforce back into the public, that as long as those jobs are still there, we have a good chance to bounce out of this in a pretty good fashion.
So do you feel a lot of this is just, more or less of the economy is just, it was put on hold, that do you feel that we're going to see some long-term effects like from that, or do you think we're going to have a good recovery?
Yeah, it's too early to tell, really. I think a lot of this is dependent upon how long we have our economy shut down. So essentially speaking, this COVID-19, there is no vaccine for it. There's no great therapeutic option at this moment. And so the only thing that we're left with is quarantine, right? So a lot of basically what we've done is we've had 75% of the economy quarantine. We've shut down businesses, and that's sustainable for a little while. The depth of this recession that we're ultimately ending up in is going to be dependent upon how long we stay in this quarantine, right? If we can have a plan to get that workforce back out there in the relatively short run, I think that we have a good chance for a quick recovery. The longer that we stay in this quarantine, obviously health is going to come first, but the longer that we stay in this quarantine, I believe that, that could drive us into maybe more lasting effects to where maybe this takes a lot longer to bounce back from.
Okay. Now, some of the bounce back that we've recently seen, is that you think that's because we're seeing some markets starting to open back up, and there's some confidence, investor confidence that they're gaining in the market, that they're looking for things to kind of open back up and get back to normal. So is that kind of what we're seeing with just the positive gains recently?
Yeah, I think it's too early to tell if consumer confidence is going to come back quickly or not. Mm-hmm. But I think what we've seen on the bounce back, like I said, it was a result of that CARE Act, that $2 trillion plan to prop up our economy. That really kind of stopped the bleeding and helped us kind of bounce back a bit. In fact, from March 23rd until today, we're actually up 26% from the bottom. So it's been a pretty significant upswing. The other piece of that equation is just the anticipation of seeing the light at the end of the tunnel at this point, that we can see that, certain states are opening up, that even here in California, we're seeing plans to get some businesses back to work. So just seeing that light at the end of the tunnel is giving a lot of optimism, and the market likes to anticipate that type of optimism and price it in ahead of time.
Okay. All right, cool. Well, let's move on to the next thing. And I want to address this one first, which is those that were, on path for a near-term retirement, and they've probably taken a significant hit. What should they be doing? That may have maybe changed their plans, but, maybe you've seen it with some of your own clients, but kind of for someone that was looking to retire in the next 5 years, how has it affected them? And, what's kind of their general outlook and their approach? What should it be?
Yeah. So those are the people that are going to need to pay the closest attention to this short run pullback that we're in right now. Someone with that 5 year or less kind of a time horizon. The first thing I would suggest is that they sit down and talk with their financial planner and discuss their investment portfolio, discuss how it's doing. So one of the things I'm looking at for my clients when markets are pulling back is I'm making sure that their portfolio is performing in a way that's appropriate given their time horizon and their risk tolerance. We want to make sure our conservative portfolios aren't getting beat up like the S&P 500 is. Though they may be dropping, we want to make sure they're not dropping as much. We want to make sure our more moderate portfolios are bouncing back a little bit better than our conservative portfolios right now. So those are the sorts of things that we're going to want to be looking at in the short run anyway, as far as performance is concerned. But for those people that are close to retirement, we want to take an individual look at their specific situation and make sure that they're being protected in a way that they need to be protected, that it's not going to affect their ability to retire when they want to retire. These things always, these pullbacks always seem really bad when they're in the middle of them. But when we step back and realize that it was a relatively short period of time, and though it was really significant when we were in it, at the end of the day, it was just a blip on the radar as we look back on this, so, months, if not years from now. So we want to make sure that these short-term pullbacks aren't going to affect a client's ability to retire. So, I wish I could give a better blanket answer, but at the end of the day, that's kind of the power in this, is that everyone's situation's individual, and they want to make sure they're talking to a financial planner to make sure that their situation is still on track.
For someone that is more short-term, I mean, how, what's your recommendation? How often should they really be, having that conversation with their financial planner? I mean, is it, because I know a lot of retirement for a lot of folks, it's a long-term game plan. So, they probably don't pay attention to it too closely, but for someone that was near, short term, I mean, how often should they be visiting that, and how often should they be having that conversation with their advisor?
Yeah, I mean, bare minimum, you want to be talking to your advisor on an annual basis. A situation like this may sound cliche, but a situation like this isn't going to change my my plans for my clients. At the end of the day, we have a plan that's meant to work through good and bad markets. And when we do have these short-term pullbacks, it's not necessary that we get together immediately to review what's going on and make changes, because the fact of the matter is we're already actively managing their portfolio. So the investment allocation is getting adjusted, whether we've gotten together or not, because we take that active fiduciary approach. But on the other side of the equation, the only time we're going to make significant changes to their financial plan is if their plan itself has actually changed. If the time frame in which they're going to retire has either shortened or increased, we're going to make adjustments as a result of that. So if life happens and things change, that's when we're going to make changes. But bare minimum, I want to see my clients on an annual basis. And the other piece of this equation is the emotion piece of it. People get nervous when things like this happen. So I think it's important to have an open door policy, that if a client is concerned and nervous, that we're there to talk to them, that if they want to reach out, we're always available.
Okay. That's great. You did mention, I just want to go back to that because I thought that was great. You mentioned an active approach to managing their money. Now, is that something that most people who have a financial advisor, is that something that's already kind of wrapped into what they're likely doing already? Or is that something that they should look into and ask about? Or, you mentioned that approach with yourself, but do you think other people may be getting that? Is that already included? Or just want to make sure that's clarified.
So a big buzzword in our community is fiduciary. So a fiduciary is someone who's legally bound to operate in the best interest of the client, right? Yep. And so in those fiduciary style of relationships, usually there's an active management component to it. Okay. Another way that you can do it to contrast to fiduciary would be suitability, right? So if the other way to get investments is through a suitability standard, where maybe we're selecting an investment that's suitable for you. Doesn't necessarily have to be in the best interest of the client, but it's suitable. And those tend to be more of buy and hold strategies. So you're not seeing a ton of active management in the suitability world. You're seeing that active management more on the fiduciary side. The majority of what we do here is that fiduciary style relationship. So I do believe that's important. It's not to say that you can't have an advisor who's working for you under a suitability standard who's doing a great job. But ultimately their hands are tied to a certain extent, because they don't have the ability to make adjustments in a proactive fashion that a fiduciary advisor would. Okay,
well, great. Thank you. Okay. So that kind of covers those that are on the short term. How about those that are on the long term? They're 10 plus years out, because I know, we're very emotionally attached to our money. And when we see big dips, and even though I may be 15, 20 years out from retirement, I'm a person, I might be calling you or emailing you that day saying, Ryan, we just dipped 5%. What's going on? What's happening to my money? Very emotional based. So I know a lot of us are like that. So what would you advise someone who's on a longer time horizon for retirement? I mean, kind of what's your, what would you be telling them, and how they should be handling this situation?
Yeah, so I think it's equally important that someone with a longer time horizon also has a financial plan that they're working toward. At the end of the day, if the goal is to retire in 20 years, at that stage of the game, it's got to be, A, is my money invested correctly based on my time horizon and my risk tolerance? B, am I saving enough? Am I going to get to where I need to get, if that retirement date is 20 years from now? So the most important thing that someone with a longer time horizon can subscribe to during times like this is just staying the course. Unless something's changed to your plan, don't change the plan, right? Unless something's changed on your end of the equation, don't change the plan based on what's going on in the markets. And that can feel really bad during times like this when markets are pulling back. There's a psychological phenomenon called the activity bias that says we need to do something to fix this. If the markets are dropping, we can do something, we can sell, we can get out, but the reality is you're not motivated to do something before the market drops. You're motivated to do something after the market drops. So selling out at that point is really just locking in those losses. And in reality, though you may get out before the market hits the bottom, you're going to sit on the sidelines and ultimately miss a good chunk of that upswing when markets do recover. So staying the course is really super important. Another mistake that I see made for people with longer time frames is when markets are dropping, they stop making contributions into their retirement accounts, whether it be their 401k or their IRA or whatever the case may be. I always joke that I work in the only market that people don't like a sale. You go into a department store, you're looking at a pair of shoes that are $100 a pair, and they go on sale for $50 a pair. You're not going to say, oh, I'm not buying those shoes. They dropped to $50 a pair. They're going to be worthless tomorrow. I'm not going to buy those. They're on sale. They're not as good as they were yesterday. But that's exactly what happens in the stock market. People look at an individual stock, for example, and it's trading at $100 a share last month. And, a few months later, it's trading at $50 a share. And they look at it and say, I'm not putting my money there. That's going to go all the way to zero. Well, that's not rational. It's not reasonable. Unless that particular company goes out of business, that stock's not going to zero. And more importantly, most clients aren't buying one individual company for their investment portfolio. They're taking a more diversified approach. So that risk of your account going to zero is very slim if you're well diversified. So keeping those contributions in place is super important at times like this because you're buying on sale. When the market recovers, that money that you put in during these pullbacks is going to have a head start for growth when the market recovers. So that money will be in the positive territory just when you get back to where we started before. Another thing that I've talked to clients about is I've had quite a few clients that have had cash on the sidelines, that they were waiting for a good time to get in. It doesn't feel like a good time to get in, but I've had those conversations that, hey, this is the best sale we've had in the market, the best discount we've had in the market in about 11 years. So let's take advantage of it. So people with cash on the sidelines, this is a good time to deploy that at a discount. And of course, we want to review your asset allocation, make sure it's appropriate for your time horizon. We want to make sure that someone who's got 20 years to go isn't overly conservative because they're not going to get the growth they need. So we want to make sure that, and we also want to make sure that it's well positioned. Never mistake a portfolio that's going up for one that's well positioned. Just because your portfolio is going up, it may not be diversified properly. So you always want to get some professional advice on that if you can. Right. And then, like I said, consider speaking with a financial planner to ensure that you're on track. If you don't have that plan already, find someone who can help partner with you to get that financial plan in place.
Great. So I just want to recap that. I think that was fantastic. So you say that your business is the only business where people don't like a sale. So what I'm hearing is that there's opportunity in what's as bad as it sounds, as bad as it seems, and as bad as it looks. There's opportunity right now. And the worst thing someone on a long-term horizon can do is to pull their money out and to stop making contributions. But there is opportunity, but it has to be a sophisticated approach to deciding on, where you're going to be putting those funds and making sure that you take advantage of that, right? I mean, it's not just, gambling and rolling the dice and, picking a stock because that sounds good. And, it's a better approach than doing that, right?
Yeah. And, there's lots of TV shows centered around this, stock picking and all of that. That's the sexy way to do it. The reality is having a properly diversified portfolio. You can use index funds or mutual funds to get good broad market exposure. That's really a good way to do it. What we specialize in is, creating portfolios that are appropriate for someone's goals and their time horizon. And so we're going to utilize great research that's available to us to determine what percentages should go where and, adjust that allocation over time as markets change and adjust. So yeah, there is definitely a a better way to do it. You don't want to just throw darts. Don't go buy Bitcoin because the market's down. You're going to start seeing commercials, if you're not already, about buying gold and all of these things that, kind of prey on the emotions and the concerns of the investor, the retail investor.
Yeah.
So, at the end of the day, don't solve a short-term problem with a long-term disaster by ditching your financial plan. You got to stay the course.
I think that's fantastic. Ryan, I really appreciate you taking time to be here with us today. And, I think there may be some people out there that don't have a plan, and, they're just concerned with, with the market. They hear that and maybe they don't have a long-term approach and plan. There may be those that are on a plan, whether it's, they were coming near retirement, or maybe they're still, on a long-term horizon, 15, 20 years out. If they want to reach out to you or get a second opinion, or just make sure that they're, in a good position, I mean, how can they do that? How can they make sure that, at least, if they have questions, I want to make sure they can get in touch with you if need be.
Yeah, definitely. So a couple different ways you can go about it. You can reach me via email at ryan.gallo@lpl.com. That's ryan.gallo@lpl.com. You can also give me a call. Just pick up the phone. Best number to reach me at is area code 562-365-1860.
And where do you do most of your business? I mean, where are you available at? I mean, so we're gonna have a lot of people probably from different areas.
So right now I'm located from my home during this quarantine, but actually we've got some plans to get back out into the world. We are technically an essential worker, so we can come out and meet people in our branches. I alluded to it at the beginning. We're actually affiliated with a credit union of Southern California. We have 18 branches between LA and Orange County. So there's always somewhere that's close. I actually have the ability to meet with our clients or potential clients at any of those 18 locations. The main office I work out of is Whittier, but I also have offices in Orange County and other parts of LA County as well. Okay. So, Costa Mesa, Orange, Anaheim, areas like that.
Okay, great. And I'll make sure we put that information in the details too. So if you want to connect with you, they can. That's about it. I really appreciate your time here today. We're going to go ahead and get the closing disclosure up. So people can go ahead and read that. So let me get that up. Is there anything else that you'd like to leave us with, Ryan?
Just thanks for having me on, Gil. I appreciate it.
All right. I appreciate it too. Thank you very much. And if we get a good response, maybe we'll have you back again, right?
That's good.
All right, everybody. Take a look at this. Ryan, we appreciate you being out, and thank you. Everybody have a good day.
You too.
Bye.
Bye-bye.